Hey guys, this is Dave again with Qualified Opportunity Funds. Just wanted to do a quick video on some common questions that I've been getting a lot asked about. You may even be asking about them or wondering about them as a potential Qualified Opportunity Fund investor. Today's Sunday. I've been fielding phone calls literally all day today. So let's go ahead. I'm going to run through just a couple quick questions real fast, and hopefully this kind of helps answer some of the questions that you have had regarding qualified opportunity funds. So first one is this, is how long do I as an investor actually have to keep my money in a qualified opportunity fund? So as an investor, technically speaking, you can put your money into a qualified opportunity fund. You can turn around and pull your money right back out. If you pull your money back out of the qualified opportunity fund prior to that 5-year mark, you're going to end up having to pay a penalty on that gains tax that you had deferred. So really, truly, and honestly, the benefit doesn't really start. That step up in basis doesn't start until the 5th year. You want to keep your money in the opportunity fund, though. Really, truly, and honestly, you got to look at this as a long-term investment. This is not, your atypical. It's not a crypto quick type thing. It's not this is not a buy and sell. This is a buy and hold type of investment. You're going to realize the benefit to the maximum at the 10-year mark. That's where you're going to get your 100% deferment. You're going to get your step up in basis value, and as long as you've held your money in that opportunity fund, then the gains on that opportunity fund are tax-free to you as an investor. Second question, and this I get, and this is a big one. Can I set up my own opportunity fund? And the answer is yes. Opportunity funds right now, they're contingent upon businesses self-certifying. Where I see that this is going to be a problem in the future over the next 18 to 24 months is there going to be some bad apples who say that they've set up an opportunity fund, and investors are going to invest, and the person's going to walk and run with their money. And we saw that happen with the home loan modification federal program years and years ago when people were charging upfront fees. I think that this has that potential to be something similar where there will be a few bad apples, and it's going to be unfortunate when that happens. But as an investor, technically you can set up your own qualified opportunity fund. Now, there's a bunch of hoops and everything else like that you need to be very, very aware of regarding not only Treasury certification, but also with SEC if you're going to go to an opportunity qualified opportunity stock. The guidance right now, there's been updated letters that have been issued to Congress regarding a little bit more clarity on qualified opportunity partnerships and qualified opportunity property. Those are going to be two big ones. I think right now, if you set up a fund, there are companies like, for example, I do it. I'm not the only one. You want to either consult an attorney or a financial planner, CPA, or a very, very solid business executive or executive coach that has an extreme experience with understanding corporate structure, tax strategy around corporate structure, understanding the ins and outs of Reg D and SEC and what's involved with that, what you can and what you can't do, the difference between qualified and unqualified, or accredited, actually, the difference between accredited and uncredited investors and how many of those that you can have. So there's a lot of ins and outs, but technically speaking, the IRS allows you to establish your own fund and to self-certify so long as you're a business, so long as 90% of that fund is being used for real estate investment purposes into these qualified IRS opportunity zones and into these qualified IRS opportunity projects, and that each project that you invest into meets the criteria of either substantial improvement or any of the other criteria. Substantial improvements is probably going to be the most common one, but as long as you meet that criteria for what you're investing in. Okay, third question. We're only going to do 4 today. Third question is 180-day window. Can you explain this 180-day window to me? I talked with not a financial planner. I talked with a individual who is facing some capital gains tax, has pretty much until the end of the month of August for his 180-day window. So here's how it works, all right? And a lot of people, if they don't get on this starting like yesterday, they're going to find that they've missed this wave by about 6 months. Those that are getting into it in January, February during tax season will have long missed the boat. The 180-day window is very simple. You sold something for a capital gains tax, you owe a capital gains tax, and you've got 180 days from the date of the sale or date of gain to roll over or reinvest the gains that you are responsible for into an opportunity fund, into a qualified IRS opportunity fund. And as long as you do it within the 180-day window, then you can defer those tax gains. And as long as you hold it, then you'll, for that 10-year period, you'll end up seeing 100% deferment. In some cases, it could be millions of dollars that you save in taxes, depending on what your personal circumstance or situation might be. I've talked with investors that have sold businesses for hundreds of millions of dollars and are facing 40, 50, 60 million dollar capital gains tax that they're responsible for. How long, or how do I know if this is a safe investment? At the end of the day, this is still an investment vehicle. It's going to be, it's qualified opportunity fund. My thoughts are, you want to look for companies that are offering qualified opportunity stock to where you as an investor can do your due diligence. If it were me, I would not invest a single cent into a qualified opportunity fund that was a qualified opportunity partnership or a qualified opportunity property. To me, I feel like that there is way too much right now that is, I guess, gray area unknown to where you could lose that investment. I feel comfortable with, even with stocks that are not publicly traded, but where they're privately held, privately issued. As a company that issues stock, there are a bunch of rules, regulations, and guidance that has to be followed as a company. As an investor, I feel like that, putting money into qualified opportunity funds that issue qualified opportunity stock is the safest place for an investment into these type of vehicles at this moment, especially if you are facing a massive capital gains tax. This is not the vehicle that is going to yield you a 20, 25, 30% return. This is a vehicle that is going to be slow and steady over the long term, and you're not investing for the gain, you're investing for the tax deferment. That's the big key and the big difference with this. For investors that are looking for qualified opportunity funds, I would encourage you check out opportunity-funds.com. More specifically, I would tell you to check out a qualified opportunity fund called Sakari Lux. That's SIKARILUXE.com. Full disclosure, it is one of many opportunity funds that I personally am part of. I did help establish that, so I know that the guidance, that the foundation for that fund is set up correctly. It is an opportunity fund that issues opportunity stock, so as an investor, you're actually getting the return on all of what the fund does, not one particular property. So there's huge upside, huge benefit, huge security aspects and built into it for investors, and you're going to get your statements and everything else like that every quarter. So be sure to check it out, www.sakarilux.com. Again, that's www.sikarilux.com. Stay tuned for more videos on qualified opportunity funds.